Every single year, three types of people quietly exit the 9 to 5 world. They don't announce it. They don't post about it. They don't throw a farewell party or write a LinkedIn post about exciting new chapters. They just disappear from the rat race. And you never hear how they did it. Not because it's a secret. Not because it's illegal. But because the people who figured it out are too busy living their lives to come back and explain it to you. And the people still inside the system? They have every reason to convince you it can't be done. I've watched this happen for years. Colleagues, friends, people with no more talent than you, no more savings than you, no better education than you. They're gone, out, free, and they did it in a window of time that most people don't even realize is closing. Because the system that profits from your labor has zero incentive to hand you the exit map. I'm going to hand you that map today. 3 methods. 1 window. Before 2027 closes, it's shut. Let me be blunt with you. If you are working a standard salary job right now, you are the product. Not the owner. The product. Think about what that means for a second. Every morning you wake up, get dressed, drive to a building, and spend the best hours of your day generating value for someone else. You get a percentage of what you create. They keep the rest. And every year, they give you a 3% raise to make sure you feel just good enough to come back and do it again tomorrow. The average American will earn $2 million over a 40-year career. After taxes and inflation, they keep less than $790,000 in real value. And most of that disappears into rent, car payments, and a retirement account they can't touch until they're 65. You spend 40 years building someone else's dream. And at the end of it, you get a watch and a window seat at a restaurant where your colleagues pretend to cry. Max spent 6 years playing by those rules. He got 2 promotions, 1 burnout, and 0 freedom. He did everything right. He showed up early. He stayed late. He took the leadership course. He put 10% into his 401k like his HR department told him to. And one Tuesday afternoon, sitting in his car in a parking garage, eating a sad desk lunch he'd driven 2 blocks to eat alone, he realized, this is it. This is the plan. And the plan was never going to set him free. Then he realized something that changed the entire equation. The rules weren't written for people like you. They were written by people who needed people like you to stay exactly where you are. So let's look at those rules. Really look at them, because once you see what's actually happening, you cannot unsee it. The financial advice industry is worth $57 billion per year. Think about that number. $57 billion. Paid to people to tell you what to do with your money. And what do they tell you? Lie number 1. Save 10%. Invest in index funds. Retire comfortably at 65. Here's the math they hide from you. $500 a month for 30 years at 7% gives you $566,000. Sounds good, right? Until you do the next calculation. The average retirement costs $48,000 a year. That money runs out in under 12 years. You're 77. Broke. No do-overs. No rewind button. No second chance to go back and do it differently. And that's assuming everything goes perfectly. No medical emergency. No market crash. No inflation spike. No period where you couldn't save that $500. Real life doesn't work that cleanly. And the advice you were given doesn't account for real life. Lie number 2. Your 401k is your best investment. This one makes me genuinely angry. Not because 401 kiloseconds are worthless, they're not. But because of what they don't tell you when they hand you that enrollment form on your first day. A single 1% management fee on a $500,000 portfolio costs you $175,000 over 30 years. That's not a rounding error. That's a house. Gone. Silently. In fees that were never highlighted in bold. Fees that compound against you every single year, the same way returns are supposed to compound for you. And here's the kicker. You can't touch that money until you're 59 and a half without paying a 10% penalty. You've locked up your wealth in a vehicle you don't control, managed by people who charge you whether they win or lose, until an age most people never fully enjoy. Lie number 3. Debt is the enemy. This is the one they drill into you hardest. Cut up your credit cards. Pay off your car. Live below your means. Debt is dangerous. And for consumer debt, credit cards, car loans, payday loans, yes, absolutely. That debt will drown you. But here's what they never taught you in school, what your parents probably never knew, and what the financial media buries under stories about people who maxed out their Visa at Target. The ultra-wealthy borrowed $5 trillion in 2023 alone, against their assets, tax-free. They call it buy, borrow, die. You buy an asset, it goes up in value. You borrow against that value instead of selling it. You pay no capital gains tax because you didn't sell. You use the borrowed cash to buy more assets. And when you die, your heirs get a stepped-up tax basis and the whole thing resets. You were told to cut up your credit cards. They were playing a completely different game, with completely different rules, and nobody handed you the rule book. In 3 minutes, I'm going to show you the one spreadsheet entry that changes your entire financial picture overnight. But first, you need to understand exactly why your savings account is actually a liability dressed up as security. Here's what I mean. A high-yield savings account right now pays around 4 to 5%. Sounds decent, except inflation is running between 3 and 4% in the best case. Which means your real return is almost nothing. And unlike an asset, unlike a business or a rental property or a digital product, your savings account doesn't scale. You put in $10,000, it stays $10,000 plus a little. It doesn't multiply, it doesn't hire, it doesn't generate recurring revenue at 2 a.m. while you sleep. Saving money is important. I'm not telling you to spend everything. I'm telling you that savings alone will never set you free. It will only slow down how fast the system extracts from you. Now here's where I flip the script. Because everything I just showed you is the reason most people stay stuck. They see the broken system, feel the frustration, and then do nothing. Or they try to optimize inside the broken system. Work harder, get promoted faster, save more aggressively. But here's the thing about a broken system. It creates gaps, inefficiencies, arbitrage opportunities, and gaps are where the money is. Meet Marcus, former HR manager at a mid-sized logistics company in Ohio. $62,000 salary, no savings, $28,000 in student debt, shared apartment with a roommate at 31 years old. He did not inherit wealth. He did not win the lottery. He did not create the next app. He wasn't a genius. He wasn't a risk taker by nature. In fact, he was the opposite, cautious, analytical, skeptical of anything that sounded too good. He made one counterintuitive decision. Instead of saving more inside the system, he stopped feeding the system entirely. He redirected every dollar he would have put into his 401k, about $400 a month, into a single cash-flowing asset. A small digital product. A PDF guide for HR professionals navigating compliance issues. The exact thing he dealt with every day at work. He knew the problem better than anyone. He packaged his knowledge. He sold it for $47. Within 18 months, that asset, combined with 2 others he built using the same model, paid more than his salary. He gave notice on a Tuesday. His manager asked if there was anything they could do to keep him. He said, genuinely and without drama, no. There wasn't. This is not a motivational story. This is a math story. And the math works in 3 very specific ways. Let's go through all 3. Method 1. The cash flow flip. Your employer pays you to trade your time for their revenue. The flip is simple. You buy or build an asset that pays you every month without requiring you to trade your time for it. Notice I said without trading your time. Not passively. There is no such thing as fully passive income, at least not in the beginning. Everything requires work up front, but the difference is this. With a job, the work and the income are permanently linked. Stop working, the income stops. With an asset, you do the work once, or you buy the asset once, and the income continues whether you show up or not. The threshold is not $1 million. The threshold is your monthly nut. Whatever you need to live. $2,500, $3,500, $4,000. When your assets generate that number consistently, you are technically free. Not rich necessarily. Free. Free to choose. Free to stay or go. Free to double down or pivot. That's the only number that matters at first. The 1% rule. Every asset you buy should generate at least 1% of its purchase price per month in income. Buy a $50,000 rental unit? It should bring in at least $500 a month. Buy a $10,000 digital product business? It should generate at least $100 a month. This is your break-even filter. If the math doesn't clear this bar, the asset isn't working hard enough for you. What kind of assets qualify? Small rental properties, digital products, online courses, licensing deals, micro SaaS tools, vending machine routes, laundromats, ATMs, content channels with ad revenue, newsletter sponsorships. The category is wide. The principle is the same. Cash in, every month, whether you clock in or not. Method 2. The skill arbitrage stack. This one is hiding in plain sight for most people. And when I explain it, you're going to think about a skill you already have. Maybe a skill you've been giving away for free to an employer for years, and you're going to feel something shift. Every job skill you have is worth exactly what your employer decides to pay you. That's it. They set the price. You accept it. The negotiation, if there is one, happens once a year in a 15-minute review meeting where you're lucky to get 4%. But stack that skill with distribution, a newsletter, a YouTube channel, a podcast, a LinkedIn audience, and suddenly you control the pricing. Because now you're not one employee competing for one salary with one employer. You're a brand. You're a media company of one. And a media company can charge what the market will bear. A mid-level accountant earns $70,000 a year. That same accountant, with the same knowledge, with 50,000 followers on YouTube talking about tax strategy, charges $500 for a 1-hour consultation. 20 consultations a month. That's $120,000. Part-time, from home, without a boss, without a performance review, without asking anyone for permission to earn more. That's not hypothetical. That's Tuesday for a growing number of people who understood this early. The stack works like this. Layer 1 is your primary skill, what you're already getting paid for at work. Accounting, project management, fitness, teaching, sales, engineering, nursing, doesn't matter what it is, as long as people need it. Layer 2 is distribution, how you reach people who need that skill. A YouTube channel is the most powerful distribution engine alive right now for this purpose. But a newsletter, a podcast, or even a simple email list works. Layer 3 is monetization, consulting, courses, digital products, coaching, affiliate revenue, sponsorships. Most people stop at Layer 1 and spend 40 years there. The people who reach Layer 3 stop asking for raises and start setting their own rates. Most people stop at Step 2. Step 3 is where the 1% live. Because Step 3 is not about income, it's about what the government legally lets you keep. Here's why. Method 3. The equity extraction method. This is the one your accountant should be telling you but probably isn't. Not because they're bad at their job, but because most accountants are trained to work within the system as it exists for employees. And the tax code for employees is very different from the tax code for business owners. Let me show you the gap. As an employee, here is your financial life. You earn money. The government taxes it immediately, before you ever see it. What's left after federal tax, state tax, Social Security, and Medicare is what you get to spend. You budget around the leftovers. As a business entity, even a tiny one-person LLC, here is your financial life. You earn money. You spend on legitimate business expenses first. Home office, equipment, software, travel with a business purpose, professional development, health insurance in many structures. Then you get taxed on what remains after those deductions. On $80,000 in income, that structural difference is worth between $18,000 and $32,000 per year back in your pocket. Legally, every year, without changing what you do, without working harder, without earning more, just by changing how you're structured when you do it. That's $18,000 to $32,000 that you are currently handing to the IRS because nobody sat you down and explained this. That money could be your first cash flowing asset. That money could be the seed capital for your OPM ladder, which I'll get to in a moment. That money, reinvested consistently, over 5 years, is the difference between still working a job and not having to. I know what you're thinking right now. This sounds risky, and I want you to sit with that thought for just 1 second. Because that thought, that specific instinct you just had, that's the most expensive belief you've ever held. It was put there, deliberately, by a system that needs you to stay exactly where you are. Risk is real. I'm not going to pretend it isn't. Every decision in life carries risk. The question is never, is this risky? The question is, what is the actual downside, and is the upside worth it? Let's talk about real risk. Starting at $500 a month cash flow asset, you can stop, reverse, learn, try again. The downside is bounded. The worst case is you lose some time and some money and you learn something valuable. That's not catastrophic. That's tuition. Staying at a job for 30 years, relying on one income stream from one employer, in an era of AI-driven layoffs, in an economy where entire job categories are disappearing faster than new ones are being created? That's not safe. That's a single point of failure. In cybersecurity, they call that a critical vulnerability. You have one system, one entry point, one source of everything. If it goes down, and systems go down, you have nothing. In personal finance, they call it being responsible. They gave it a good sounding name. They made it feel like virtue. But it is fragility dressed up as wisdom. The real risk is doing nothing. Staying put, hoping the company doesn't downsize, doesn't automate, doesn't restructure, doesn't change leadership and decide to go in a different direction. That's the bet most people are making. And the odds are getting worse every single year. The clock on that risk is ticking faster than most people know. Here is something nobody in the financial media will say out loud. The window for the kind of moves we're talking about today is not infinite. It was wider 5 years ago. It will be narrower 5 years from now. The people who moved in 2019, 2020, 2021, they got in before the audiences got saturated, before the real estate prices climbed, before AI started eating the skill layer that most people thought was safe. The next window is now. And 2027 is the marker I use, not because something catastrophic happens on January 1st, 2027, but because the compounding math of an 18-month head start, started today, puts you in a completely different position by then. Started 18 months from now? You're behind. You're catching up. You're paying higher prices for assets that were cheaper today. I promised you something extra. Something not in the title. Here it is. It's called the OPM ladder. OPM, other people's money. This is not a trick. This is not a gray area. This is the exact playbook that every major corporation in America uses to grow. The only reason most individuals don't use it is because nobody ever explained that it was available to them too. Step 1. Form an LLC tonight. Takes 20 minutes online. Costs under $100 in most states. You are now a business entity. That single step changes how the tax code sees you, how banks see you, and how potential partners see you. Step 2. Apply for a business credit card. Most major banks offer business cards with 0% introductory APR for 12 to 15 months. You now have access to capital that costs you nothing to borrow for over a year. Step 3. Use that capital to build or buy your first cash flow asset. A digital product, a storage unit, a vending machine route, a small content site, something with recurring income, something that generates cash every month. Step 4. The asset income repays the card before the 0% period ends. The interest never kicks in. The capital was free. You just used the bank's money, not your savings, not a loan from family, not a crowdfunding campaign, to buy your first piece of financial freedom. No personal savings required. 0% interest. Legal. Available at every major bank in the country. Right now. Today. That is not a loophole. That is the exact mechanism large corporations use to grow without deploying their own cash. Amazon did it. Every private equity firm does it. The difference? Tonight, you can do the same thing. From your kitchen table, in your pajamas, without an MBA, without a financial advisor, without asking anyone's permission. You came here looking for a way out of the 9 to 5. What you actually found was a way into ownership. That's the shift that matters. Not escaping work, owning something. Not running away from income, building income that doesn't require your daily presence to exist. 3 methods. 1 structural shift. 1 OPM move you can make tonight. The cash flow flip. Build or buy assets that pay you whether you show up or not. The skill arbitrage stack. Take what you already know, add distribution, control your own pricing. The equity extraction method. Restructure how you earn so the tax code works for you the way it already works for the wealthy. The window is open, but markets shift. AI displaces faster every quarter. The gap between those who moved early and those who waited is compounding right now, in real time. Every month you wait is a month someone else gets that 18-month head start on you. The people who will be free in 2027 are not smarter than you. They don't have better ideas than you. They weren't born into better circumstances than you. They just started 18 months earlier. They made one decision, then another, and the math did the rest. You just got the map. The next move is yours. If this cracked something open for you, wait until you see what's coming next. The dollar's purchasing power has already started collapsing. Not theoretically, not eventually, already, right now, in the grocery store, at the gas pump, in your rent. Most people won't recognize what's happening until it's too late to position themselves ahead of it. The next video will show you exactly what to do, and what to own, before the full impact hits. Don't scroll past it.